Hank Gutman. Now, Hank is the current...
I've never been on anybody's right before.
And we'll hear a little bit more about that later, too, I'm sure.
You know, when you face me, I'm on the left, okay?
But Hank serves as the KPMG accounting firm's director of their Tax Governance Institute. I think most seminally, Hank is known as being in the 90s, was the chief of staff for the Joint Committee of Taxation. Now, that's the primary nonpartisan advisor to the House Ways and Means Committee and the Senate Finance Committee on all aspects of tax legislation, tax policy, so he brings a tremendous perspective from that regard. Hank has taught at the University of Pennsylvania and the Virginia Law Schools. He served as the chairman of tax policy and government relations committees of the American Bar Association and a number of other bodies. Hank comes out of the Woodrow Wilson School of Public and International Affairs from Princeton University. He's got a BA degree in jurisprudence as well from Oxford University, and an LLB degree from Harvard Law School. To my immediate right is Larry Langdon. Now Larry also has a very distinguished career. Larry is currently with Meier Brown, which has a major office here in Chicago, but Larry serves as a partner and a director of their global tax practice based in California, Palo Alto, I believe, since 1993. In 1999, when the IRS reorganized itself and stood up with a new organization, Larry was the first commissioner of what was then called large and mid-sized business for the new organization, and was a seminal leader in leading the IRS into the next century, if you will. Prior to that, and for many, many years, Larry is with Hewlett-Packard in Washington through a number of roles and capacities. One of which was he was the Vice President of Tax, Licensing, and Customs, which gave him a tremendous perspective on the international business realm and ties right into our topic of today, which was how does a company make investment decisions worldwide? Larry has a BS and a JD degree from Ohio State University and an LLM in taxation from the NYU School of Law. With that being said, let's get right into it. I'll moderate this a little bit, but I'm going to invite the panel, as we discussed, that we can all share our thoughts together. We have some slides that are theme slides. We don't intend to become tax technical here. We're not going to get down into the depths of international tax planning. We don't have the time. There are courses that would go on for months around that and still barely scratch the surface. In addition, we have an audience here that's made up of consular officials representing a number of countries that are based here in Chicago. International business leaders are here with us today, and besides people from the Internal Revenue Service, and some current students from the Masters in Tax program itself. What we thought we'd do is talk about the elements that a business person needs to think about when they're making an investment decision about where they would invest overseas. And yes, taxes is part of that, but only a part. So with that, I think our first slide talks about tax is not the first consideration. And Larry, given your experience at Hewlett-Packard when you led a lot of that international business planning, perhaps you'd like to kick us off a little bit.
Well, first I want to commend you for being in the audience and choosing taxes as your profession. I will submit that it's the most interesting part of corporate America from a lot of different standpoints. Secondly, I got into taxes because my parents and grandparents were all CPAs, and they taught me that accounting is the language of business. But then I will submit that taxes is the icing with regard to the language of business in a very material way. Secondly, you are anticipating with this panel and with this discussion the global economy. And I know when we in LMSB stood up, we took our executive team down to Emory University, and we had a very interesting dissertation by two different professors who claimed the future of the world is either in China or in India, and we need to catch up with regard to that. And I'm very proud that the IRS, and we have two IRS executives here, who've done training abroad with regard to emerging countries in tax administration. So understanding what's happening on a global standpoint is extremely important. But Kurt, let's go to your topic, because there are probably 7 to 10 factors that businesses look at with regard to making decision making, and taxes could be number 6 or number 4, but rarely number 1 with regard to that list. I spent time, as Kurt pointed out, at both Ford and at Hewlett-Packard, and you think about automobiles and PCs and printers, and you think these are totally different products. You can ship PCs and printers by airplanes, which is what HP did. You rarely ship automobiles by airplanes. You build them locally, and so there's a totally different business model with regard to Hewlett-Packard on the one hand, Ford Motor Company on the other, perhaps the GEs of the world in the middle, but then Procter & Gamble, hearing their Vice President of Taxes speak recently, they have to localize their product in a very material way, even more than the auto industry. So localization and, in effect, local content, local workforce are key issues that make a difference. And let me give you one interesting illustration. When I was at HP, I was called by my CEO, who was in a European country, and said, "Larry, catch the next plane here. We need your help with regard to negotiating the acquisition of a major company." And the key obstacle, quite frankly, was labor, because in effect, the labor rules in this European country didn't permit downsizing. Yet they wanted the tax guy there, because in effect, my CEO was very perceptive, and that this company would not buy into our royalty methodology, which was required for IC pricing. And that ended up being the excuse with regard to not doing the deal. But the real reason was labor, because in effect, they had 100,000 workers, and we couldn't absorb those number of workers. So when you really, look at the factors with regard to what a business is doing, what the nature of its business is, what its products are, where they're manufactured, taxes are a material consideration, but they're not the be-all, end-all. Hank, what would you want to add to that?
Well, I'll wait to weigh in when we start talking about national tax systems. Just my only point would be to emphasize what Larry has said. The world in which we live is a tax world, and so we tend to think that that's the most important factor in the world. And indeed, today, this is just sort of a little reality check for you. When you read about what's going on fiscally in the United States, we know that we have a serious fiscal problem. A lot of the debate that's going on is about reducing our corporate tax rate to make us competitive. I happen to think that there's a lot to that, but also it's overblown. And the real thing to focus on is the business reality of where you're doing business, the things that Larry has on the first slide and on the second slide. It's not to say that taxes are unimportant. They are important, but we'll talk about that and try to put it into a context for you.
Well, in that vein, I'd like to add to Larry's war story a little bit. When I was a corporate tax head, at one point we had an airbag business, and we were looking at expansion of the airbag inflators that you see in automobiles into Europe. We knew we wanted to be based in Europe. Personally, I was at the time, as the head of tax, I was kind of pushing for Ireland, because Ireland even then had a very low tax rate. We could have done Ireland, to go to your point, Larry, because we could airship these small inflators into Volkswagen or Fiat or some of the other automobile manufacturers in Europe cost competitively. But there were other factors that really came to the fore. One of the primary ones was, frankly, one of our vice presidents had a chalet in France and preferred France. We therefore went through a lot of these things about labor rates, education levels, union versus non-union, and no denigration to France, but France is known to have a high labor rate and to have some very strict rules around their union environment and what's required there. That as we looked at other countries in Europe, France being still a wonderful country, didn't quite remain at the top of our list for investment. But just to add to your story there, if I may. But Larry, I'd like to ask you a question, going back to one of our first slides on things. I think people understand what the commercial rule of law is and reliability. But can we maybe expand? Have you ever run into problems on the legally mandated local ownership requirements and what that's all
yes,
about?
and you find those rules in both African and Asian countries, and typically what happens, which when I was in the oil patch was a concern, is local ownership by 40%, which in effect you need local investors, which was at the time a rule in Nigeria, and earlier there was a similar rule in Malaysia. And so in effect, managing that investment with regard to local ownership, but more importantly, the board of directors, which are local nationals, and making sure that there's good efficiency and communication with regard to decision making is a concern. So there are barriers that countries put in place that end up being a material concern. I remember having a board meeting out of Nigeria, and the local Nigeria people came along, the board members, and they also brought their wives. The wife of one of the Nigerian directors was a very accomplished lady. She was a medical doctor. She started making comments at dinner with regard to her view of egalitarian status between men and women. And then my colleague, who was British, whispered to me, "That wife is not coming anymore to the board meetings." So there are little sidebar things with regard to understanding what's going on in the country and, in effect, how to do business efficiently that is a material concern. I think we as Americans need to be more multinational in our thinking and understanding of different values and cultures, but sometimes these create problems. Moving to the next point, in high tech, ownership of patents is extremely important, and can you defend them? And so the General Counsel may object to transfers of technology abroad because he or she will not be able to support those rights in countries where, in effect, the judicial system, and we'll pick on China for a moment, is not well formulated with regard to supporting those rights in a court of law. Political stability, and I will add to that integrity in relationships. Earlier point in time, quite frankly, it was during the Marcos era, Hewlett-Packard refused to put a manufacturing site in the Philippines because the way of doing business required facilitating payments. And as an ethical American company, and of course that's violation of law, both from a tax and a legal standpoint, we didn't want to put our executives and employees in the status of having to deal with that. So all of those issues are important. Another key thing with regard to globalization, which really gets to our workforce issues, Hewlett-Packard had a very good experience with regard to going to major universities in America and recruiting basically local nationals that had come to get scientific and MBA training in the United States, and in fact bringing them on board and saying, hey, 5 years from now we want you to go back to your home country and be a general manager because we want local leadership with regard to managing that. All of those factors to a degree are outside the tax realm, but they're extremely important with regard to managing the global business on a material way.
For instance, just to build on what Larry said on, for instance, educational levels, if you look at today's Wall Street Journal, there's quite a large article about the challenges India is facing on that front. Even though they don't have as many language barriers in terms of dealing with an English-speaking country, because it tends to be a language that cuts across a number of their regional languages and used as a common language in India. And even though they're well known to have updated a lot of their business practices to invite foreign investment, so that India has become known for, particularly Western firms, outsourcing a number of their technology support things to India, they're running up against an educational challenge that the Journal does quite an interesting in-depth article about just today.
I remember talking with HP executives whenever I travel abroad that they wanted their kids to know English because they knew that was the future of global business. and two, if at all possible, to get them into an American university so that in effect they could ensure the pragmatic side of their careers. There's an interesting flip side that's happening here and in California, which is increasingly white folks want their kids to know Mandarin, because Mandarin is the language of the future with regard to dealing with China businesses. And the amount of globalization that has occurred in the Pacific Rim, not only in India, as you point out, but China is important. And then the latest phenomenon, which is an increase with regard to Chinese businesses beginning to outsource their businesses to Thailand and to Vietnam because of labor rates, because the labor rates in China are creeping up. So all of these things are important things that we as a country need to be sensitive to with regard to not only educating our workforce, but understanding the global trends and the global future. I think the current number with regard to HP sales outside the United States is close to 75%. Only 25% of the sales of Hewlett-Packard products are now in the United States. So increased globalization with regard to manufacturing and certainly marketing and distribution processes are absolutely key.
And I might point out some of the same considerations would be in place for investments inbound into the United States. The very same things would go on. For instance, I can think of one of the strengths that's going on recently here in the Chicago area is over the last decade or two, as Japanese had more and more representatives of their business functions here, we have a number of Japanese schools, both primary and secondary, because they too would be interested in their children being fluent in Japanese when they go back to their home country. So they're making sure that they can get culturalization into their home country. I'm sure the same is true for a number of other countries doing business here, but it's just one of the facets that whether you be a master's in tax student who will someday be in a corporation or in a professional firm advising your executives on the facets of investment decisions, or if you're a consular official and you're interested in encouraging outbound investment from the United States into your home country, these are some of the things that you need to think about even before we get to tax.
Well, just if you go back for a second, one more slide. The political stability and integrity and relationships point, I think, is one that's extremely important. Certainly I've seen it, and I suspect Larry and Kurt, you really saw this more directly than I. Looking at essentially political stability, the risk of expropriation, for example, which is a serious factor in many countries, and also changing the rules in the middle of the game, particularly with respect to ownership requirements, tends to be something that really has to be assessed very carefully, because the local ownership requirement can really constitute a serious impediment to efficient operation of your business. And so you need to pay a lot of attention to that, but even more importantly, in a sense, you have to be cognizant of the stability of the political regime or the political system. Another thing that's sort of interesting is that these things are interdependent as well. For example, if you're in a country that has very, very low labor rates and also has some skilled labor, that's going to be a very attractive proposition for a subset of companies. And in that world, that country may well say, we'll get them here because we have this comparative advantage with respect to one or two of these other factors, and that means we can put into place any tax system we want. And I think that we know of a couple of countries who basically have been operating under that premise. And that's something also that you need to worry about and see and get a little predictive about that, because there are, as I say, there are some countries who, because of their comparative advantage in other areas, create a tax regime that is really hostile to the inbound companies, and nonetheless they can do it because they can do it.
So moving along, we thought we'd still stay with the theme of some other general economic considerations, but some of the things that, again, do come to the fore with investment decisions, whether inbound or outbound. Larry, I don't know if you want to start off with commenting about any of these points here?
No, absolutely. In fact, site selection is a very important process within the corporation with regard to lining up the metrics that are important. We all have our anecdotal stories with regard to, the CEO deciding, well, I need an operation in Switzerland, or I had a vice president had a sailboat in the Caribbean that did facilitate us moving a Puerto Rico manufacturing operation. But it does tie in to the second and third parts of that, because interestingly, as you may know, Puerto Rico citizens are also U.S. citizens. And the government of Puerto Rico has a very aggressive program with regard to putting their best and brightest into American universities. And then they were obviously keen on returning to their homeland, so to speak, and working for a U.S. employer. So in effect, getting talented people in that regard was a real plus in a very material and interesting way. The other key thing is, and of course at that point in time we had a code section called 936, which was really a tax incentive for those, which has since gone away. In effect, Puerto Rico now is treated as a CFC for tax purposes. But more importantly, once you've got an operation going in a country, it frankly is difficult to dislocate that. In fairness to a lot of emerging countries across the world, the workforce are very incentivized to work hard, to in effect have career migration within the company, and the amount of loyalty is superb and exceeds that even within the United States. But then by the same token, you need to have infrastructure in place. And so in effect, there are certain places in the world, like Ireland and like Southeast Asia, where in effect the infrastructure and companion companies for Hewlett-Packard and for the auto industry were firmly in place. In effect, you need an array of suppliers, you need the logistics and shipping, and then the repeal of tariffs in a very material way, reducing under the GATT basically for high-tech products being zero rated, really allowed for interesting mobility of products in a material way on a global basis. So the emerging rules with regard to all of this are something that really requires continual assessment, and then most importantly, access to local markets and being able to sell your products there has allowed American businesses to thrive. But as Kurt, you pointed out, now we have inward bound investments, because in effect North America is used as a very interesting marketplace for those that have source of supply, manufacturing operations, and basically headquarters companies outside the United States.
And sticking with your theme, and I was looking here at the local investment incentives. This is true whether you talk about cities competing in the United States to pull a business in from someplace else. State-to-state competition, we were just talking about that at lunch today, where the president of Caterpillar sent a letter to the governor of Illinois complaining about the recent tax increase in Illinois and his firm being wooed to relocate to another state. The same is true internationally. I mentioned France before, and to be fair to France, inside of Western Europe, their rates and their union rules really aren't all that different from a number of the other states. So one of the tipping points in terms of our investment decision when I was in corporate America was looking at some of their local incentives we might get from any one country. Or sometimes it's a province or a city within that country in terms of what location breaks they might give us. Sometimes they'll give you the building. Sometimes it might be a tax incentive. We'll touch a little bit more about international tax planning toward the end of our presentation. But these kinds of factors certainly do tip the balance sometimes between one decision and another. And this is one of the things where, again, if you're a student here in the Masters in Tax program, you need to think about if you're going to be interfacing with your corporate management. You can't be blindsided and just be thinking taxes. On the other hand, you are the key advisor for letting them know what the tax tipping points are. I think, Larry, I know you have a lot of experience with inbound and outbound shipping and tariff costs. I don't know if you want to say anything about that.
Yeah, in fact, it is interesting. As you may realize, we made a lot of printers in Singapore. And one of the interesting trade-offs, because for 5 years I managed logistics for Hewlett-Packard, we found that if we could schedule the manufacturing cycles properly, a lot of times using container ships rather than airplanes with regard to shipping those goods elsewhere in the world was a more efficient way to go. We also would charter planes as well as a way of ensuring a source of supply. So the key point is this: with regard to a number of products, particularly if the value is high and the weight is low, you will tend to centralize that manufacturing at a number of key spots in the world for global distribution, rather than reproducing those manufacturing facilities across the world. The auto industry are at the opposite end of that spectrum, because in effect shipping cars is a good part of the expense.
But to build on your point, that is why, for instance, the pharmaceutical industry tends to be so mobile around the world. Similarly, you mentioned Hewlett-Packard in the computer industry. The same could be said, I think, with the software industry.
That's right.
Well, in large part, that has to do with the assets that they control. I mean, if what you've got is a patent, which is highly mobile in terms of being able to move it around, and generally speaking, very, very profitable, anybody who's doing tax planning #1 knows that what you want to do is move that asset into a place where it's going to be lightly taxed, so that you can capture the profits from it. And we'll get into some of the aspects of that a little later on about transfer pricing and whether that's done in an appropriate manner in terms of cost sharing. But the fact of the matter is that there are many jurisdictions that are much more amenable to being receptive for intellectual property in particular. And that's become, by the way, a big problem in the United States, or at least perceived as a big problem in the United States. The fact that pharmaceutical companies and folks with intellectual property of all sorts have been moving that property outside the United States and keeping the profits outside the United States as well, which is perceived as a problem here, and we'll talk about that. But these highly mobile assets can be moved around, and if you're thinking about maximizing your returns, you simply have to be thinking seriously about what countries are most receptive for those particular assets.
Right you are, and Hank, that's a great segue into the tax considerations. So let's start in on that. We've got some bullet points here. Larry, you want to start in on one or two of those bullet points?
No, absolutely. And let me give you a personal bias, which is you really need to think through the tax plan you recommend for your bosses if you plan to stay around with the company for a reasonable period of time. Because a lot of ideas that people put in place really won't be sustainable in audit in the local jurisdiction, including the IRS, and also with regard to dealing with tax dispute process. Now, if you want to create the tax disputes, come and see me. That's what I specialize in with regard to resolving things, but it gets very expensive, and particularly if you go to court. So think through the process with regard to end to end. The second major thing that I always thought was extremely important, which I learned in small boat sailing when I lived in Michigan, is when the wind shifts and you're coming into the dock, you always have to have a way of escape. So if your tax planning is so bottomed down and tied down so that you can't adjust to changing law and circumstances, that's not very good tax planning. So keep that in mind with regard to doing it. But taxes are an important consideration. In fact, moving to the second one first, I found that on a global basis, because of our presence in Europe and across the world, Hewlett-Packard's pay substantially more in value-added taxes, which was a bottom-line tax, than in income taxes. So in effect, make sure, and I had a substantially more number of people involved in the U.S. and abroad with regard to consumption-based taxes than in income taxes with regard to compliance. I know Hank and I are fans of a value-added tax in the United States, but the cost of administration of value-added tax is not cheap. It is broad-based, and it does raise a fair amount of revenue. And most countries in the world, including the emerging world, have found that value-added tax is a very quick and reasonably easy way to raise revenue and support government. And in fairness, taxes are what we pay for an organized society, so we need to keep that in balance. But you're required by your bosses to, in effect, come up with the most efficient, effective, and appropriately legal tax system on a global basis, and that requires taking into account competing considerations. Now, in the United States, we still have, you know, a remittance type system, and you'll get that detailed in your courses, and in effect dealing with that in a constructive way is extremely important. You don't want to end up with excess foreign tax credits and excess limitation, which is more not in effect paying U.S. tax on foreign income more than you pay in the way of foreign taxes, is an asset that needs to be wisely used. And rates, as Hank alluded to, is a key initial consideration, but I will submit it's not the be-all, end-all consideration. It's just one factor in the analysis, and even I would submit a 5 to 10% rate differential may or may not overcome other factors with regard to where operations are located. So be sensitive to all of that. That, I guess, is kind of the overall philosophy thing. Now, please add to that, Kurt.
Well, I'd like to put a little context on that.
Sure.
Your comments were very apropos, particularly if we think about the students who are here in the program. I'm thinking about those here who are also representing their own countries.
Mm-hmm.
You are not holding yourself out to be a tax expert. We understand that, and that's why we're not getting deeply tax technical here today. On the other hand, if you're trying to encourage inbound investment into your country, you should know that after all these other considerations we mentioned, tax will come up. Now, many businesses will be well advised by law firms or public accounting firms, a number of whom have offices all around the world. However, it is, I think, more and more true that a small business and mid-sized business is looking to expand overseas, and that's a new wave happening. They're sometimes unsure. Their own smaller CPA firm or smaller law firm may not have that expertise. And this may be a value-added element that you as a consular official might consider within your own operation, if you'll let me use that term. Are there some local tax expert firms within your home country that are available to serve as an advisor? I would defer to you about those relationships and everything else, but you might want to think about how can you help a company considering investment into your country with all of these considerations, the labor rates, the education levels, all these other systems, and then also these tax considerations. What value added could you bring to that dialogue, even as you do not hold yourself out to be a tax expert? So that's an open question, I guess, that we'll leave you with. Hank, anything else on that?
No, not on that.
I think, Hank, this is one that maybe naturally tees up with some of the thoughts you'd like to bring to bear based upon your experience here in the States and what you've seen around the world.
Yeah, I mean, the issue here is, in large measure, what does the tax regime of the country in which you intend to do business look like, and how stable is it, and what are the processes for change? And here what I want to do is initially make a contrast between the United States and basically the rest of the world. And the contrast is on legislative process. This is very, very important for folks to understand. And now I'm really addressing this comment to folks who are looking at the United States as an inbound investment. And the principal point is this, that we have a very, very different legislative system very different way of making laws than most of the other countries in the world. With a conservative government coming into place and immediately enacting a program which met some resistance in some areas, but was fairly draconian in other areas in raising taxes and lowering taxes. What they did in the UK was, on the tax side, lower the corporate tax rate, but they paid for it by increasing taxes on individuals and increasing the VAT, which its political acceptability is a little mysterious to me, but it nonetheless happened. The government hasn't fallen, and of course the Treasury just proposed a new budget in which it intends to lower the corporate tax rate even more, because the UK has said that they are open for business. They're open for business. They're going to change the way they tax non-UK source income as well, moving toward what we call a territorial system, where the active income is taxed in the source country and then can be repatriated or brought back to the home country without payment of further tax, a big issue here in the United States. But the point here is that you can watch what happens in all of these other countries and be fairly predictive about outcomes. And you can't necessarily be as predictive about stability, though, because governments can be elected on a program and change a system on a dime. So that's sort of a downside to the predictability of those systems. When you come to look at the United States, the world is entirely different. The world is entirely different. And this is just on a process point. The president can propose anything the president wants to propose, but the Congress of the United States enacts laws. That's why I get bemused sometimes when I read about things like Obamacare. Well, the president didn't dictate our health care program. The Congress passed it. And so you need to understand that here we have a very, very different dynamic. And the predictability of our process, or at least the ability to be able to understand what and when something is going to happen, just doesn't exist. And we're seeing it right now. I mean, you can't, if you pick up the newspaper this morning, you'll see that just in our fiscal situation, we face something that's absolutely impossible to think about in another country. We may have to close down our government. Kurt may not be able to go to work on Saturday because on April 8th, unless, now maybe he likes that. In fact, even if he wanted to go to work, he couldn't. But that's, if this thing happens. I mean, can you conceive of any place else in the world where we're in a situation where our government isn't going to be funded come Friday unless there's some kind of agreement? Can you conceive of a situation in which, because of political pressures, it is possible, extremely unlikely, that come the middle of May, we would be defaulting on our national debt because the administration and the Republican and the Democratic parties can't reach agreement on fundamental issues? I mean, that just doesn't happen in other places, at least not to this extent, and not in countries that are run by people other than folks on a horse, you know, with a sword, saying this is the way we're going to do it. So, for those of you who are looking at things on an inbound way, you have to think, you know, how do I assess what's happening in this country being the United States, and what are the likely prospects for change? And that gets us immediately to this question of corporate taxes and the extent to which corporate taxes matter. I'm going to leave state and local taxes aside for a minute. Now, here in the United States, we have a corporate tax rate of 35%. Japan is about to lower its rate, and so we will have the highest nominal tax rate in the world, at least in the industrialized world, 35%. Everybody says, we have to change that. We have to change that. That's way too high, and you'll not get any disagreement from me. But there's something that's very interesting when you get behind that 35% rate, and you say to yourself, or you ask yourself the question, gee, what is the real rate of tax that business pays in the United States? We take their taxes as a percentage of their worldwide income, and what's what we call the effective rate of tax on business income? The answer to that is, well, it's somewhere in the neighborhood of 27%, which is, by the way, about the same tax rate of the OECD countries. So you might say to yourself, well, what's all this shooting all about? I mean, you got this 35% rate, but obviously there are ways to avoid that tax, because if business income is really taxed at 27%, what do I care? And in this country, the reason you care is because if you're a domestic company that is a service company or purely domestic in terms of retailing or manufacturing, you're going to be paying pretty much at the highest rate of 35%, because the things that exist in the code that provide the opportunity to reduce your tax rate don't exist for a lot of those entities. On the other hand, if you're a well-advised multinational company, particularly in the pharmaceutical or in the software business, you find that your effective tax rates are well below 25%. Now, what's that all about? That's all about the fact that you have a tax base that differs depending upon the type of business you're in and what you do. So when you look at the system, you have to be very cognizant of the fact that there are what we call tax expenditures or preferences in the system that materially affect what your rate of tax is going to be. And that's what this whole debate, the big debate in the United States, is about: lowering the rate on the one hand, and also how we tax income earned outside the United States. For inbound investors, I mean, I would say we really ought to have a low rate in this country, because not only does it affect our own domestic companies, but it makes the United States a better place for inbound investment. The debate in the United States isn't a lot about inbound companies. You don't hear congressional speeches about how we need to attract more direct foreign investment, at least not very often. But nonetheless, it is something we need to be cognizant of. Lowering the rate, particularly in a way that provides the advantage for the inbound investment that doesn't otherwise exist, is a great way to go. And so when you look at the United States and you say, are we a good place for an inbound investment? At the moment, I can't tell you whether you are or you aren't, because you've got to examine our tax structure and see whether the preferences that are available for companies that are based in this country are available for you. But certainly the move here is to try to lower the rate and broaden the base, which in general is going to be a good thing. Well, that's a microcosm of debates that go on around the world. We have to look, and when we're thinking about our investment decisions, now on the inbound side, what can happen to the domestic tax structure in the United States, and for U.S. companies that are going outside the United States for outbound investments, the issue is going to be, how is the active income from those investments going to be taxed? But for those who are thinking inbound, we're in the midst of a wonderful debate that you want to pay some attention to, because the end game here may be, and should be, a system that's going to make the United States a lot more attractive to you. That's my sermon.
Well, and it's also, I think, very instructive for all of us, no matter where you're sitting in your own professional capacity here today. But that kind of also is a natural segue then into some of the more particular points around tax planning. And while we're not going to get, again, deeply technical, I think it's time to introduce some of those concepts. Now, Larry, you and I have worked in that vineyard in the past. You now continue to advise clients who maybe are having problems around some of these issues. Why don't you kick us off?
Well, it does also relate to the next slide, because what you have to deal with in this regard is basically what we in the tax profession call, Code Section 482, intercompany pricing, the valuation of intangibles, and a functional analysis. And increasingly, governments have followed the United States in two material ways. One, with regard to Code Section 482, which is, in effect, we want arm's length pricing with regard to transfer of goods, services, and intangibles. And secondly, in that regard, we want an increased use of economists in dealing with this, including economist reports that are filed in connection with the tax returns. And so, in effect, the Code Section 482 regulations in large measure have been enacted globally by a very important government body called the OECD, which is based in Paris, France. And so the OECD guidelines are the template with regard to OECD developed countries, which I think now note number 34, but do not include a number of key countries that are emerging players on the global scene, including Russia, China, and India, that are in the queue to join the OECD, with the pluses and minuses with regard to all of that. Why do we emphasize all of that? It's extremely important that when we deal with global tax administration, that we have uniform rules. If we don't have uniform rules, and every country can be its own pirate with regard to going after the income that is reported in that country, that results in double taxation, and it may not necessarily result in those taxes being credited. So in effect, you can drive your effective rates substantially higher than the 30 or 35% rate that Hank described. So increasingly, understanding of global taxation on a more than a pedestrian basis is extremely important, and it also relates to effective tax administration. And many of the governments of the world have invested in trying to bring all the countries in alignment in a material way. Over lunch, I had lunch with two of my IRS colleagues who had spent time in the Far East with regard to instructing emerging countries in both tax administration and 482. The United States does that well, Canada does it well, the United Kingdom and Australia have invested substantial resources in bringing other countries in alignment, which I think is extremely important from a budgetary standpoint. And the International Monetary Fund and the OECD invest in these means as well as the United Nations. So there are global efforts to bring increased alignment. But that doesn't mean that there aren't challenges. If you think about China for a split second, and admittedly their tax base is primarily based on a value-added tax, they now have 1 million auditors with regard to trying to put that system in place, which is no mean challenge, because if you think about either value-added tax or income tax systems, it's based on solid accounting and also good business records. And if a country fails with regard to providing that, the job of tax administration is humongous. So it is an evolving challenge, but again, you all have the background to help out in that regard. I will submit that that in effect focusing on the international part of the equation with regard to your career development, I submit is extremely important as you think about what you do next, no matter which of the venues you come from in that regard.
And to circle back to something we talked about before in terms of stability, we've got this term up here, the arm's length method.
Right.
I can remember 25, 30 years ago when the first what's so-called white paper came out from the U.S. Tax administrators, Treasury, IRS, etc., around the arm's length principles and pushing for that in terms of what would be required. And there are quite an extensive series of regulations that have been updated several times around what that arm's length principle means. Interestingly enough, the United States may not be as enamored with the arm's length principle these days, because there have been some difficulties in terms of what they see as happening with U.S. multinationals or U.S.-based multinationals being taxed at too low of rate relative to the transfer of some of their intangibles offshore. And so there are talk, or there is talk, about trying to modify that perhaps. The problem from the U.S. point of view internationally is they convinced most of the rest of the world that it should be this arm's length principle. So, will there be stability there? I don't want to even hazard a prediction.
Well, it's a really, you raise a really interesting point. Now I am going to do something that we said we weren't going to do.
That's all right, it's your neck on the line.
It's my neck on the line, right. See, this problem to which Kurt alludes is a problem that is, it's a problem that's based on, or is focused upon, U.S.-based multinational businesses. Now, the same thing could occur in any other country, but I'll just use us as the paradigm example. The issue here is, how do you tax income that's earned outside the jurisdiction? And with what, and what are the effects of doing that? Now you see, every country says we want to be competitive. And who could disagree with that? Of course you want to be competitive. The issue is, how do you define being competitive? And if you ask business how they define whether they are competitive, what they'll say is, I'm competitive when I can compete with a foreign-based company in a third country and have my taxes be the same. And that's fair enough. But if you ask others about how they define whether a country is competitive, they'll look at it a little different way. All of the policy folk will look at will define a country as being competitive if its national standard of living progresses at the same or a higher rate than that of the rest of the world. Now, when we define competitiveness in those two different ways, the ships are passing each other in the night, because there is no particular evidence that the ability of a U.S. multinational to compete against another country's national in Uzbekistan is going to make any difference at all, significantly, to the United States standard of living. It may or it may not. So we have this enormous debate that's going on in this country, and we're seeing it happen in all of the other countries around the world, maybe not as a debate, but as a consequence. Do we tax all of the income attributable to a domestic entity, no matter where it's earned, at our domestic rate? That's called the worldwide system of taxation. Or do we provide that any income that's earned outside the United States, and I'm going to have to make a distinction here between business income and other kind of income, all that business income that's taxed outside the United States, let it be taxed at the source, and then you can bring it home without any payment. Now, those are two very different systems. And the debate in the United States, which is a microcosm of at least the considerations, if not the debates, that you hear in other countries, is this. If all of my income, no matter where earned, is taxed as currently as possible at the U.S. rate, there's no tax advantage to going abroad. And indeed, there's no transfer pricing game that you can play either. It doesn't do any good to transfer your assets to Ireland, because you're going to be taxed at the U.S. rate with a foreign tax credit for your Irish taxes. So in a world, one of the arguments for a worldwide system is you don't run into these kinds of problems. And taxes do not become a factor in the decision making as to where a U.S.-based company is going to operate. And just turn it around and think about it from your own countries as well. Now, the counter argument, of course, is that really I have to be able to compete in these other countries, and so therefore I shouldn't be facing a higher tax burden on my earnings, which happens if I'm taxed at the U.S. rate, and that other rate is lower. Well, take it a step further. The consequence, or the alleged consequence, of having a system in which the United States allows source taxation says that if the source tax rate in the country is lower than the United States, that's an incentive to move manufacturing abroad. And we don't want to see that here. We want to have a tax system that's going to encourage job creation in the United States. So when this debate that you see emerging in the United States about what kind of system we ought to have with respect to the taxation of non-U.S. source income arises, the fundamental debate is about job creation in the United States and its effect on, and the tax system's effect on it. And if it were only a question of taxes, you would know full well that the worldwide system would be the right way to go. Now, the problem with saying that is that conclusion is too easy. And I'll give you an example of why the conclusion is too easy. If we believe that we measure competitiveness on the basis of standard of living, rather than whether Boeing can compete against Airbus, take as an example, I'll say, a furniture manufacturer in one of the United States, like, let's say, North Carolina. And there are 20 employees. And the owner of that company sees that if he moves his manufacturing to Mexico, why, he can produce product much more cheaply, bring it back into the United States, and sell incrementally more product at lower cost, lower prices to the consumers than if he kept his operation in North Carolina. Now, the 20 people in North Carolina who lose their jobs don't get the joke. They don't see the advantage of this, but it may well be to the advantage of the United States to be able to have that furniture come in at a lower price and more people be able to buy it. So if we think about competitiveness and measuring it in terms of what enhances our standard of living, you can see that the analysis that goes into picking one of these systems over the other is very, very complicated. Very, very difficult policy thing to work your way through. That's going to be a sort of a subset of the debate in the United States as we think about lowering our rate and how we tax foreign income. Most of the rest of the world right now is moving away from this worldwide system and moving toward what's called territorial taxation, or this taxation at the source only. The UK is going there as well, and there are good reasons for doing that. But it's not a slam dunk as to which one of these is the appropriate system. And when you think about or try to advise with respect to what the outcomes are likely to be in the legislative process, you need to understand that this is a very, very complicated analytic issue. It is not one that's cut and dry, quite apart from any of the politics that are involved in it.
As you know, most companies do not like uncertainty in any material spec, particularly with regard to taxes and other areas of liability. And so accordingly, quite properly, a number of years ago, the IRS created an initiative under basically their treaty network with regard to creating advanced pricing agreements, which in effect create a degree of certainty on certainly a bilateral and occasionally on a unilateral basis with many of the treaty countries within the United States. These are very, very important tools. They're similar to the tools that LB and I have with regard to the so-called CAP program that is now permanent. It also relates to the pre-filing agreement program. So in effect, getting a degree of certainty with regard to what the tax consequences are in an area of uncertainty is extremely important. Let's move to the next slide, which is basically competent authority, which is also a treaty-driven arrangement with greater or lesser extent of success because of the difference in national tax administrations and their ability to reach compromises. And that's why on the next tier of emerging tax treaties, we were able to campaign and get Congress's concurrence with regard to putting an arbitration clause into these competent authority arrangements, which in effect will bring closure more quickly. These are all tools that are important.
Well, thank you, all three of you. This was great food for thought, a lot of great information. Proves that things just get more complicated and more complicated, but for all of us, I guess that's a good thing. We can continue to work on it. So please, on behalf of the Niagara Foundation and the University of Illinois MS Tax Program, join me in thanking our three panelists.